Hi, welcome back to the Wealth Optimization Workshops. Scott Collier, the Callback here. Very excited. One of the favorite topics people have when it comes to talking about financial planning, RRSPs, the Registered Retirement Savings Plan that we have available as Canadians. Going to dive into some fundamentals around it, and then we're certainly going to hit much more in depth on investment principles moving forward for any of these types of accounts. So let's take a look. What is a Registered Retirement Savings Plan? Obviously the name indicates the main purpose being for retirement savings. However, there's other things you can do with them as well. So we'll talk about that. Something to be aware of, 18% of your earned income every year is eligible to be invested. However, if you have not been contributing the maximum, which most people, to be honest, do not contribute the maximum to the RRSPs, if you haven't been, you do have carry forward room from the past. So you may have significant space available to invest in RRSPs for you and or a spouse. The current limit for the 2019 calendar year, $26,500. Last year was $26,230. You have up to 60 days into each new year. So for example, up until March 1st of 2019, you could have made a contribution for your 2018 tax return. Hopefully that makes sense. So that happens each year in the first 60 days that you can apply those contributions back to the previous tax year before you file your taxes. Now, the retirement savings have complete investment flexibility. Every imaginable investment, stocks and bonds and GICs and mutual funds and segregated funds and annuities and different types of investments that you can build inside of the RRSP. The RRSP is not an investment. It is an account that tells the government how to tax that investment. And so how do they tax the RRSPs? You get a tax deduction. So if you contributed $10,000 this year into your RRSP, they will reduce your income by $10,000 when you file your taxes. And therefore, you will have some significant tax savings. The higher your marginal tax bracket, the more advantageous to you. General theory is that you're in a much higher tax bracket in your working years than you are when you're retired. If that's not the case, then that's something to rethink about how you use your RRSP money. So we're going to talk more about that, but we'll dive much deeper into investment options and investment strategies in subsequent presentations. I just want to understand how that RRSP account can be used when you're investing money. So great that there's a tax deduction, and the growth is also tax sheltered. However, when you withdraw money from an RRSP, it will have withholding tax, and it will be treated as income on your next tax return. So it is not your emergency fund. This is not where you come because the car broke down or because you need quick access to cash, right? This is primarily used for retirement savings, for long-term savings. You should have other money like we've already been talking about when it comes to emergencies or shorter-term savings purposes. Hopefully that makes sense to you. Spousal RRSPs. Where would this fit? If you've got two spouses and one has significantly higher income, so a higher marginal tax bracket than their spouse, and often this person may also have significant pension or retirement savings, and so you can use it for income splitting purposes to try to split income as equally as possible in retirement when you're withdrawing the money. This is where a spousal RRSP would fit. Now, one thing to keep in mind, the person contributing the money gets the tax deduction. So the higher income earner gets the tax deduction this year when they contribute. However, this spouse here, they're the ones that own the money in the plan. They are the ones that will be pulling the money out in retirement and taxed at their income level in retirement, not this person. Therefore, there is a 3-year attribution rule that if this spouse invests money as a spousal RRSP and then they withdraw the money in the first 3 years, it will not be taxed to this person. It will be attributed back to that person for tax avoidance rules. So hopefully didn't confuse you too much there, but keep that in mind. Couple of other opportunities. We touched in the home ownership section on the home buyers plan. So again, you are allowed to withdraw up to $25,000 for the first time home buyers plan. A couple could withdraw $25,000 each, as long as they repay it 1/15 per year over 15 years. They can get up to $50,000 between that couple to buy their first home for the down payment. Another opportunity, you can withdraw up to $10,000 per year to a maximum of $20,000 for the lifelong learning plan. Often people don't know this, but this is more and more relevant. You think of people and they constantly have to change careers now. The days of a career where you might spend 30 years in the same career is much rarer now. It is much more common that you're going to need to be retraining, relearning as you go through life. You can use that RRSP money to help re-educate yourself. So let's say I suddenly needed to re-educate myself, I could tap into RRSP money to help do that. So that's something to keep in mind for yourself as a good opportunity to take advantage of as well. Hopefully all of this makes sense. One thing I should mention, the spousal rollover. What is that? What if one spouse passes away? So you've got two spouses, one passes away. That RRSP money can roll over to their spouse on a tax shelter basis. However, when both spouses pass away, that money on second death will be deregistered and all treated as income in the final year of life for that person. So when you're planning, we're going to dive much deeper into retirement income planning and retirement income strategies in an upcoming session. Just be aware of that. We will dive deeper into that topic. Hopefully you're as excited as I am about the potential for RRSPs, but also realizing where they are a good fit and where they aren't a good fit. They are not the investment solution for every situation. We'll talk much more about that as we go along. Thanks for joining in. Talk to you soon.